Good evening. This is Ken Long at Tortoise Capital, and I'm going to introduce some new material, some holistic trading material that I call Trading the Pinch and Stretch. And it's a discussion about how we can build profitable trades, looking at the life cycle that symbols will go through from being super pinched on one extreme to fully expanded on the other extreme. This is material that really came together in the 2017 live trading and research weekend workshop in Kansas City. And so I'm appreciative to all the folks who contributed with their presence and insights and curiosity. So let's get going. So I believe that there is a price cycle that all symbols go through that takes them from moments of being super pinched to fully extended. And I'll cover that, what I mean, in detail a little bit later. But this cycle of price action, going from contracted to expanded, is created by decisions that traders make and investors with different time horizons, and makes that target tradable throughout that cycle of pinched to expanded. By knowing where we are, we can formulate good plans that take into account where it is in the life cycle. So, by looking at those symbols and where they are in the cycle, traders have a sound framework for reducing the uncertainty in their trading decisions. This is consistent with our approach at Tortoise Capital, where we look at statistics to look at global equity markets and analyze on the basis of low risk, high reward opportunities that make systems that can give individual traders a robust edge. We develop complex trading systems and conduct our workshops and seminars looking at short term and intermediate term trading systems. And basically, we're using ETFs, large cap stocks, and futures contracts for the most part. Some of the main beliefs of this system and strategy and framework is a belief that from extreme conditions come extreme results. That in any population of symbols that you will have some targets that are at one extreme on the dimension you're measuring, whether that's volatility or relative strength. You'll have extremes on one end, the blob in the middle, and extreme conditions on the other end. And it is by looking at the extreme conditions that extreme results derive. That something extraordinary happened that pushed those symbols into those extreme conditions, and that those extreme conditions are recognized as abnormal by the humans that were trading them, and that from those human reactions to the extreme conditions, even more extreme conditions will result. Either a continuation of the original behavior that made it extreme, like a second leg, or a reversion to the mean. And because it already started at an extreme condition, the move back to the mean is also a large move. So it's our belief that extreme conditions come extreme results. We're treating the conditions of pinched or stretched as extreme conditions. And then we see the evolution from one to the other as a life cycle, which gives us a direction to trade and a structure to trade. We take into account different time frames, and so whatever time frame you're operating on, you may be seeing signals which traders on other time frames will be looking at as noise. And we need this belief in order to remember that just because something is set up properly the way we like it and we're expecting certain behavior, that other time frames don't see that information in the same way and doesn't cause them to trigger behavior in the way we might desire or which we might expect. And so taking into account different time frames now becomes an important part of this framework, and I'll show you how we account for that through the use of regression lines. So by looking at the daily pinch and stretch statistics in a tortoise way, that will tell us where the boundaries between normal and abnormal are seen. So let's get into it. So when I talk about a pinch, what I mean to say is that price volatility has become abnormally compressed. And the significance of this is that price is now postured for a breakout in either direction. So I want to take a look at this at two different time frames. First, on the intraday time frame, and I'll be referring to our intraday RLCO and Bollinger Band framework for this detailed interpretation, and our frog system. So on an intraday time frame, we've had a lot of success by looking at a measurement of signal versus noise we call the frog box 1.0. And we treat the frog box as a unit of measure that distinguishes between signal and noise intraday. So price movements that are directional, that are less than a frog box, we see as noise. And it takes a sustained move greater than one frog box before we begin to see what we call signal, or evidence of a directional move intraday. So using the frog box 1.0 as a measure of being pinched or not, when price is within that frog box for an extended period of time, we would say that it is pinched. In standard practice, we like to see that price is oscillating within a box the size of zero point 0.7 frog box, so even tighter compression than a frog box 1.0. I should say that the frog box, for those of you who are not familiar with our frog system, the frog box is a daily computation based on previous price action that gives us a statistical measure of signal versus noise intraday. So in our RLCO framework, we use Bollinger Bands of 30-period look back, and we are concerned about the Bollinger Band 3 and -3. So we call these are z-scores, or how many standard deviations away from the mean price is. And so we see 3 standard deviations, we call that z plus 3 and z minus 3, or collectively just the z3 lines. Now statistically, about 99.5% of price action in the previous 30 bars has fallen between the two price levels marked off by the z3 lines, and equally distributed on either side of the Bollinger Band mean. Just basic math. So when we see both Z3 lines have pinched inside the frog box, or refined 0.7 frog box, we recognize that as a special condition of sideways quiet channel, or we call that pinched. The pinch box we would take as the boundaries of the Z3 lines. So you can see here the Z3 lines. It takes a lot of sideways movement for the Z3 lines intraday to compress to less than one frog box. So when we see that condition, we call that the pinch box, and our general strategy is going to be on the Z3 pinch breakout, or the Z3 PO. We want to go long if it price comes out of the pinch box to the north, and short if it goes out to the south. So on a Z3 PO in this first situation, enter with a breakout using the far side of the pinch box as an initial stop, and then we keep that initial stop in place until the Bollinger Band mean also leaves the pinch box. And when that's happened, we have reasons to believe that we're seeing a directional move that has left behind this pinched channel. We are prepared in a Z3PO to stop and reverse. Quite often we'll see what we call the Z3PC, or a Z3P channeling. So some price action has caused this pinch box in this channel to form. And then we get a price breakout, and we follow that. But if that doesn't follow through, if this is not the beginning of a directional move, then we're not surprised when this thing becomes an anomaly of a breakout and then reverses and then targets the far side of that pinch box where it was bound before by the compressed Z3 lines. So a Z3P channel, or a Z3PC, occurs when we have a Z3P breakout, and then usually within 10 bars we get a stop and reverse, which is the re-entry of the channel, and then we stop and reverse with a target of the far side of the channel. And quite often we will see that When the Z3PC occurs, not only does it get to the far side of the channel, but now a strong directional move occurs this way, almost as if this were a one final head fake to gather all the stops for the channel traders, and then we get a strong double size move in this direction. And so the Z3PO and the Z3PC are our way to handle this this pinched condition intraday. Now, we've been very satisfied in trading this Z3P approach, the combination of the breakout and the channel intraday for a couple years. And because we have a belief in the fractal nature of markets, we were looking for an equivalent approach that would allow us to have the same strategy and imagery and concept on swing trades and position trades. And so this year I feel like we've been able to do that. And so our requirement then would be to find a swing trade equivalent of the Z3P condition, but which was appropriate for swing and position trading. By position trading, I mean, months, weeks and months. Swings, I'm looking at trades that we're handling for days and weeks. And so our solution is to compute the daily pinch box. And what we're doing with the daily pinch box is defining it mathematically as the standard deviation of closing prices over the last 30 days. It's important to note this was slightly different than the computation of Bollinger Bands, which look at open, high, low, and close. We are strictly looking at the closing price. And so there can be a difference in the actual numbers computed by our standard deviation and those used to build Bollinger Bands. However, this is not a difference that makes a difference because we're using it consistently throughout this strategy. So it's important to understand that. And so the method that we're using to calculate pinch and stretch conditions for swing and position time frames is the following. First, we're going to compute every day the daily standard deviation. We're going to do that for each of the last 500 days in order to establish a large statistical baseline. And in those 500 days, we're going to find the maximum, minimum, average, and the standard deviation. We're then going to compute the z-score of today's pinch box with respect to those last 500 days to find out where today's pinch box, standard deviation at closing price last 30, we're going to compute that z-score to determine within those 500 days just how pinchy or stretchy or expanded that standard deviation is. So to do that, we're going to compute a pinch box percentage so that we can actually compare those last 500 days. If you try to just compare it on a straight dollar basis, you'll get distortions because price will have moved in those 500 days. So what we really need to see is the relative volatility of the price of the last 30 days compared to itself. And so that's why we take the standard deviation of price last 30 divided by price in order to come up with a pinch box percentage in order to properly and fairly compare it to the last 500 days. Then we use a straight mathematics to compute the z-score, which is today's percentage minus the average percentage divided by the standard deviation of the pinch box percentages of the last 500 days. And that will give us a number that equals the z-score. And so then by definition, we have a signal that today is pinched if the z-score from today is less than -1. Shown statistically, then we can look at it this way. We can essentially compute the standard deviation of price of the last 30 days divided by price to come up with a pinch box percentage. We do that for the last 500 days. We find the maximum, the minimum, the average, and then we compute that standard deviation, and we make it +1 and -1 markers, so this defines the normal range of pinchiness. This is the maximum then would be the one in which we had the greatest standard deviation of the last 30 days. And then we define a pinch condition as the price has to have been abnormally stationary for the last 30 days in order to make a minimum or small standard deviation. And so we call it pinched whenever today's z-score, today's pinch box percentage z-score, is less than -1, then we would say that today is pinched. We would also find that it is among the narrowest um, the narrowest compressions of the river in the last 500 days, and that it's primed for a sharp move. So, whenever you see the pinch condition, then when you look at a big chart, you would notice on a daily basis that the Bollinger Bands look abnormally pinched. So by doing this, we now have a means of applying the same principles of our intraday trades, where we're using the frog box as the marker for pinchiness. The Z3 lines have to be inside there. Here we are simply using the measurement of the standard deviation block, or that piece of math that is used to compute Z1, Z2, Z3 lines. We're just all we have to do is look at the size of that little block of the standard deviation on a percentage basis to determine if it is pinchy. The next thing I want to look at is what we call the super pinch. So if we're going to define the pinch as a condition where the price volatility has become abnormally compressed, and remember, you can only get to pinched if the last 30 days have been, or the last 30 bars have been very tightly compressed in a sideways kind of a channel. We then add a new set of conditions called the super pinch, and we say that something is super pinched when first it's in a pinched condition. Now, whether this is intraday or daily from the previous chart, it doesn't matter. But we say the price is pinched and all four regression lines of interest are within the pinch box. Now, we take the four regression lines that we use, the RL10, 30, 90, and 270, and we say that each one represents the estimate of fair value of traders from different time frames. We take the RL10 to be the shortest term traders, the fast traders, and that for them is the real smoothed price. RL30 we say are short term trend traders who are a step slower than the RL10s, so this is the slow trader. The RL90, which is the RL30 times 3, think of these as intermediate term traders and becoming investors, and the RL270, which is 3 times the 90. These are long-term investors relative to the shortest term traders. Now, if I'm looking at 1-minute charts, then the RL10 is built on 10 1-minute charts, and the RL270 is based on 270 1-minute candles. If I'm looking at daily charts, then the RL10 is constructed by the 10 daily candles and the RL270 by 270 daily candles. And so what we're really describing and defining these regression lines to represent are relative to each other on that time frame that we have price versus long-term fair value. So if I'm an intraday trader and I'm using 1-minute charts, the RL270 is looking at 270 minutes of data, and that's 2.5 hours. And that even to a position trader, that looks like day trading. So that's not really a long-term investor in the mindset of a pension fund portfolio manager. But relative to a 1-minute trader, RL270s looks like a long-term investor. And so this is the way that we account for the different positions of traders all along the spectrum, from the shortest tick traders to 1-minute candles, 3-minute, 5, 10, 30, hourly, 2 hourly, daily, weekly, monthly, quarterly, annual. There's this long range, this long spread of different time frames that investors and traders can take. And so what we're using in our time frame of interest, based on the RL10 for price, we're looking at these 4 different time frames as 4 different populations of people with money to spend and who are estimating fair value in different ways. So when we talk about a super pinch, then what we are saying is that the four regression lines of interest are also in agreement as to fair value, and that fair value is also contained inside the Z3 lines, which are pinched inside the unit of measure. So intraday, that's inside a frog box, or refined a zero point 0.7 frog box, or the standard deviation box is abnormally pinched. That's what gets you to pinch. Super pinch gets you to the case where not only is it pinched, but all four regression lines are inside that tight area. So for one brief shining moment, as we have said in the chat room before, all four time frames are in unanimous agreement on what the current value is and what the current fair value is, and the volatility is so compressed that it's just waiting to break out. It has to break out or it's going to stay in there forever. And when it does break out, the RL10 will be the first thing that leaves the pinched area. And then depending on whether that's persuasive or not, or the momentum causes other people to trigger and go in that direction, you will see one or more of these regression lines also leave the pinched area. When all four leave the pinched area and we have some directional moves, this could be the beginning of something large. If it is a head fake, or if the other regression line time frames don't follow through, then there will be abnormal excursions by the RL10, and then it will come back into that pinched previous condition. So in our view, when we see this super pinch, what we have is a combination of a pinched condition and a unanimous opinion of fair value of the four RLs. This creates tension, and we treat this as a special opportunity for a larger than normal breakout. I expect to see a breakout that's going to go to a new pinch, followed by a resolution of this difference of opinion among the traders. And so in this case, where we have a super pinch condition and then something triggers the traders, followed by the RL30, to take it to a new area of consensus. It's moved down to leg one and then begins to compress into a new pinch that is measurably different than the original pinch. What you'll see in the regression lines is this kind of image, that the 10 and the 30 move to a new level. We call that leg one, and then you get some consensus. And now you have a temporary difference of opinion between the fair value and price defined by the short-term traders in this new pinch, where it's forming an SQC, sideways quiet channel, or C3 pinch, and the long-term fair value that's marked off by the RL270. You'll see that the RL90 will have moved some distance between the short-term traders and the long-term holders, and we treat that as an intermediate target. The negotiation about what kind of trade this is still open. And so what we look at is this idea that when we get to a new SQC or Z3 pinch, that and we have a leg one move down, that we expect this tension between short-term traders and long-term holders to be resolved in one of two ways. Either the length of this leg, which represents the power of the traders to move price away from fair value, is going to give us another leg of the same magnitude, or it's going to revert back to the mean. And then we treat the RL90 as that intermediate target that tells us, yeah, it seems to be moving in that way. We think of it as a checkpoint. So when we see a super pinch and then it moves at certain distance, and then we see a new pinch formed, defined either by the daily or the intraday definitions of pinch that we've used before, we can frame a trade, and we think it could be one of three kinds of trades. If it reverts back to the mean, then it's the kind of a trade. Then the trade we're going to see next, the trade frame, is a return to the original fair value. And in retrospect, if it does that, the original super pinch price level is going to be seen as the correct fair value, and that the leg one was simply an anomaly or an excursion, that an experiment that didn't work, and we will see it revert to the mean. Or we may see that this price level remains at the new pinch, but there's no additional follow through in either direction, and eventually over time the 90 and the 270 will bend down and join them at this new price level marked off by the leg 1 excursion, and then this could become the new long-term fair value once it's joined by the 90 and the 270. That happens more rarely. That traders were immediately able to move it to a new price level, and that new discovery was exactly correct, and then everybody comes around to it and agrees. The third thing that we could see is that leg 1 results in this sideways quiet channel, and then we get a second excursion down to leg 2. If you see that, then we interpret that as traders trying to discover the next fair value wherein all of the 4 RLs can come to an agreement. So there's that whatever caused it to fail in this case, there's more of that coming and more momentum, and now the 90 and the 270 will roll over and start joining it down here in search of the new fair value. And that continuous set of excursions can occur until price levels off long enough for the 90 and the 270 to rejoin, or for a reversion to the mean to occur where everything comes back to join all 4 RLs together. If you get more than one leg down or up, in retrospect, we will see that the original super pinch will have marked off a important intermediate turning point, whereas whatever price action got it here, it then gives us a different long-term price action, and then that will be seen as a major turning point. Now, one of the things that we can do then when we're trying to understand the behavior of our targets is that by measuring all previous excursions of the RL10, the fastest regression line to change, and the excursion from the 10 to the 270, which is the slowest to move, we can then use those excursions to describe the relative power of traders, represented by the RL10, to pull away from long-term investors, defined as the RL270, and this difference of opinion between the shortest term traders and the longest term holders in this framework is the essence of the regression line fractal framework, which we call the RLFF. And then by estimating and describing the size of those moves on a percentage basis, we can then put statistics on it and describe when a excursion from the 270 has no longer been a normal or small move, and when is it abnormally large. And we can use our understanding of statistics to describe the percent of a move that it has to see for that excursion to be abnormal. This is a form of statistical description that we call the stretch statistic. That once we've understood the percentage moves that are the average of the last 500 days and the maximum and the minimum, we can start defining z-scores of those moves to tell us what our expectations of the next move might be. So once we've understood how this symbol behaves, whenever priced, the RL10 leaves the RL270, how far it can go historically and statistically, we can use that to start calibrating our expectations for the kinds of moves that can occur from super pinch conditions in order to frame our reward versus risk ratios. If we use a breakout from one side of that pinch or super pinch measure as our entry, and we use the far side of the pinch condition as the boundary of the channel, if we use that as our unit of execution risk, we can then compare that to the size of these typical moves away from the pinch conditions to determine if we have favorable reward to risk ratios. We can also incorporate other measures of support and resistance to further refine our trade frame, but on the basis of just these descriptions, we have a way to maintain an edge in the market by having sound mathematical basis for describing potential future moves. When we're looking at intraday applications of this, as an example, now I want to drill down to the intraday. What we will have just done is that we look for the maximum excursion of the RL10 from the RL270 during some look back period. This is typically 500 time periods. And we take the maximum move of the RL10, the blue line, away from the RL270, and we describe that distance as how much power the traders had on their best day to move price away from the existing fair value. That yellow represents their relative ability to move price away from this long-term average or this long-term fair value. And so on the blue line, when we have a which we treat as the daily open, one of the ways that we'll use this is that as the day unfolds, we will find the high of the day and the low of the day, and then we can compute our range stat from the frog system, and then we can find the upper limit of intraday moves by finding the low of the day and adding the range statistic to the upside, and we can find the high of the day and subtract a range stat move to the downside, and then from wherever price is inside of this channel between high and low, we can compute the maximum reasonable intraday moves using the combination of high and low of the day plus the range stats. So when we see the day unfolding, we always know where those upper and lower limits of reasonable moves are between high of the day minus range stat and low of the day plus a range stat. That gives us the boundary of reasonable moves. So when we see a super pinch occur intraday, like a Z3P super pinch, we have, let's say, a 0.7 of a frog box, and the Z3 lines have compressed, and there's the Bollinger Band mean. So now inside this super pinch box, the pinch box, we have the RL10 in blue, the RL30 in black, the RL90 in green, and the RL270 in purple. And the two Z3 lines are inside this super pinch box. Then our strategy is to buy a breakout to the upside, and in this case we would say a reasonable upside target is this low of the day plus a range stat, and then a breakout to the downside would be a Z3 the Z3 super pinch breakout would be to the high of the day minus a range stat. So we can use our statistical measures to give us additional insights into the kinds of moves that are not surprising when it breaks out from Z3. The main idea is that this doesn't happen very often. Maybe once or twice a day. You'd be surprised to see that happen twice a day. But if it happens once a day, then what we define that super pinch as when all RLs are inside of that pinch box and all four of those regression lines are saying we're at fair value right now. You're now waiting for the breakout from that pinch led by the RL10 and price, and then you can set your boundaries for the maximum intraday move as a test of the low of the day plus range stat or the high of the day minus a range stat. Now you have calibrated the size of reasonable moves that are all driven by the statistics of previous daily and intraday moves that allow us to compute these various statistics. So this is a standard practice for us. And then what we find is that if price were to violate one of these high of the day minus range stat or low of the day plus range stats, that becomes the boundary condition for abnormal behavior or irrational exuberance. And our trading strategies intraday are designed so that when these pinch breakouts occur, that we have money in hand as it approaches these statistical limits. And then if it starts to fail, we harvest those gains quickly because we're at the limits of normal moves. But if it breaks through, we are now in a position to use markets money to begin exploiting the irrational enthusiasm of traders as we get perhaps a truly large intraday move. So the combination of intraday framing and the frog boxes, along with our statistical measures that come out of the frog system, allow us to exploit the pinch and super pinch conditions in very profitable ways. And just as the intraday statistical analysis gives us these insights, we can use these excursions of RL10s from the RL270 as ways to further estimate the size of moves on the longer term time frames. All right, I want to stop there for part number one and give you a chance to digest.